You're listening to the Connecticut Real Estate Edge podcast, your source for tips and tricks on building wealth through real estate in Connecticut. You will get the best techniques from leading local experts in real estate and lending. Now, here's your host, Robert Weinberg.
Today, we're going to dive into a topic that many homeowners often overlook, but it's a true financial treasure chest, and that is the equity in your home. Home equity is one of the most valuable financial tools that you have as a homeowner and that you can access. Whether you're planning on a home renovation, consolidating debt, or retirement, your home equity can help you get there, and I'm going to show you how today. So let's start out by talking through the basics about what home equity is and how it builds up. So in simple terms, home equity is the difference between the value of your home, the market value today, and how much you still owe on your mortgage or other liens on the property. So it's the portion of your home that you truly own. And for most people, home equity builds up in two different ways. The first one is paying your mortgage down over time. So every time you make a payment on your mortgage, part of that payment goes to interest, but the other part goes to principal as well. So when it goes to principal, that actually decreases your loan balance, and that in turn increases your equity. As the mortgage balance goes down, your home equity position goes up. The second way to build equity is appreciation. If the value of your home increases over time, so does your equity. And that appreciation happens no matter how much you owe on your mortgage. So whether you put no money down or really low down payment, maybe 3 to 5%, or if you put 50% or more down, it doesn't matter when it comes to appreciation. The value of the home is going to appreciate regardless of what you owe on the mortgage. And we've seen home prices really appreciate significantly, specifically over the last 2 to 3 years since COVID. And that means that today, in 2024, homeowners across the country, especially in Connecticut, are sitting on a larger amount of equity than ever before in history. So imagine you bought a house for $300,000 a couple years ago. Now it's worth $400,000. Well, if your mortgage balance is $250,000, that means you have $150,000 in equity. And you can access a portion of that equity for almost any reason, as we'll be discussing. So in the next segment here, I want to talk about the ways that you can access the equity in your home. A lot of people think that you have to sell your home in order to access the equity, and that's absolutely not true. That's a huge myth that I want to dispel right here. Because accessing the equity in your home while you're there, while you either live there or you own the property, has some huge financial benefits. And here's the main ways that you can do it. The first way is a home equity loan, or HEL, home equity loan. This is essentially a second mortgage on your property. So you borrow against your home's equity in a lump sum. You get all the money up front, and then you pay it back in a fixed monthly payment, much like your primary mortgage. The interest rates on home equity loans are generally quite a bit lower than other types of loans like credit cards, personal loans, and you can get all the money up front, as I said, so there's a huge attractiveness there. The second way to access equity in your home is a home equity line of credit, or HELOC, H-E-L-O-C. HELOC is how it's referred to most places. Now, a HELOC's a little more flexible than the home equity loan because, similar to a credit card, instead of getting a lump sum, all the money up front, you have access to a line of credit based on the equity that you have. You can borrow as needed up to the approved limit, and you only pay interest on the amount of money that you use. So HELOCs are really attractive for ongoing projects or expenses that you aren't really sure about in the future because they offer so much flexibility. Another thing I love about HELOCs is the ability to re-borrow money over the draw term. So most HELOCs have a 3 to 5 year period where you can borrow money out of it and pay it back open end, as I said, much like a credit card. So if you have a $50,000 line of credit on your home and you pay it down to $40,000, you can then go back a few weeks, a few months later, and you can re-borrow the money out. It's called an open end loan. or open-end mortgage. So that's why these are so flexible and so amazing for a lot of cases, is because of that ability to have the open end, money in and money also comes out. That's unlike any other financial product attached to your home. Another way that you can access equity in your home, as we've talked about on previous episodes here, is a cash out refinance. It's one of the most popular ways to access equity. And in a nutshell, you just refinance your current mortgage for more money than you owe on it, and you take the difference in cash minus any closing costs or fees that are paid. This can be beneficial if interest rates have dropped since you first got your loan, because you could potentially lower your interest rate and pull out cash at the same time. So it's a double whammy benefit there. And I have clients right now in 2024 that bought homes 1 to 2 years ago, and they were sitting at interest rates that were in the high 6s to 7% range. And now we've been able to do exactly that, refinance them, lower their interest down into, in many cases, the 5 and low 6 range, and also consolidate debt or pull equity out at the same time. But because many homeowners that have owned their homes for 5 or more years are sitting on ultra low rates, because of that, the cash out refinance in a lot of cases, it's going to be unattractive going from, say, a 3% mortgage to a 6% mortgage. So that's why these other options we're talking about, home equity line of credit and home equity loan, are more beneficial in a lot of ways and a little bit more flexible, as we talked about. Cash out refinance is a closed-end loan, so you get all the money up front, similar to the home equity loan, and then that's it. You pay it back over time. Now, the last option that I want to touch on is home equity sharing. Okay, home equity sharing. This is a new type of product that's out just in the last 12 to 24 months I've been seeing it. I do not recommend this product, equity sharing, at all. It's a predatory product, in my opinion, for almost everyone. And basically the way it works is you give up a share of your future equity in exchange for cash now. So this is popular with people that have really bad credit and can't get one of these other loans. Maybe you have little to no income and can't qualify and that sort of thing. So this is your only option. Home equity sharing may be your only option, but it's predatory. You're giving up a lot of equity. Generally, you're paying back many, many times more than you would pay back with a typical loan. And if your home value goes up significantly, the more your home goes up, the more money you pay back when it comes to paying off the home equity sharing. So I do not offer home equity sharing right now. It's something that, again, I really don't believe in, and I think it's being used in a predatory way by many companies that are offering it. Ultimately, when there's more education out there on it, I think it's got a good place. But right now, a lot of the people that I'm finding using it and clients that I'm speaking to that are getting approached with it, it's just not the right solution. These other options like home equity loans, lines of credit, and cash out refis are more viable solutions than home equity sharing. But I didn't want to go through this episode without mentioning it because it's something you're probably seeing and hearing quite a bit about. Now, in our next segment, I want to discuss what you can do with home equity and what I'm seeing as the most viable options that people are using their home equity for today in the market. So now that you know how to access the equity in your home, let's talk about what you can do with that money. So the first way that I'm seeing a lot of homeowners using their equity today is to reinvest it back into the home. So you can use money to remodel your kitchen, add a bathroom, build an addition, or any of the above. And not only does it improve your living space, but it also, in many cases, can increase the value of your home, building even more equity for future, whether that means selling in the future or financing and getting access to that equity. So there's a good option there to take money out of the equity and reinvest it to create even more equity, right? Another reason that people actually use their home equity today, probably the number 2 reason I'm seeing right now, is debt consolidation. If you're carrying high interest debt, and right now today, high interest debt, like anything over 10% interest, okay? Credit cards, personal loans, medical debt, student loans in some cases have high interest. Using your home equity to pay it off can be a smart move because by consolidating your debt, you're going to get a lower interest rate on a home equity loan, HELOC, or refi than you are on a regular other loan, like we're saying, personal loan or credit card. Those are going to be significantly higher interest rates than you're going to have on the home equity options. So you can save a significant amount of money and interest by consolidating your debt into your mortgage or using the home equity to consolidate debt. It also takes multiple payments and turns it into one. So you might be paying 4, 5, 10, 12, 15 different accounts. We can pay them all off and consolidate into one account under the equity of your home. Really smart move for a lot of people. Educational expenses is a huge reason people are using home equity. If you've got kids heading to college, or maybe you've got really expensive private school tuition that you're paying right now before college, maybe you're even thinking of furthering your own education. Home equity can be used for all these types of tuition costs. And because the interest rates are generally lower than private student loans, it can be a better financial choice. So evaluate your options when it comes to educational expenses and look at home equity as a potential, at least in the mix, to evaluate and make an informed decision. Another reason people use home equity is for an emergency fund. So we always recommend to have 3 to 6 months of liquid savings for emergencies. But sometimes things happen and you get off track. Maybe you don't have that emergency fund. So tapping into your home equity in a pinch can be that financial lifeline. And in this case, I generally recommend a home equity line of credit as a backup emergency fund, because then you're not paying interest until you actually need to use it. I've got clients that have home equity lines set up for $25,000, $50,000, $100,000. They have zero balances on them. They're not paying interest. They just have it for the rainy day, for the next opportunity that comes up. Another reason that people use home equity, and one of my favorites, is retirement planning. So if you're a homeowner approaching retirement, home equity can be especially powerful for you, because you may be able to actually use your equity in your home and consider a reverse mortgage, which allows you to access that equity while still living in the home without having to make any monthly payments required. And this can provide a lot of cash flow for retirees, especially if you've got a lot of equity in your home but not a lot of income coming in. Okay, I personally have a reverse mortgage as part of my retirement plan. It's a big part of it because I've seen the difference it can make in people's lives if it's used correctly. The reverse mortgage of 5-10 years ago is very different than the one today. So I would encourage anybody thinking about retirement, if you've got a significant portion of equity in your home, generally 50% or more equity, then a reverse mortgage may be a very viable solution. And it's absolutely worth evaluating to run the numbers, see how much equity you can get. Another thing I love about the reverse mortgage line of credit is that it grows over time. So it actually goes up every year contractually. And that's different than any other line of credit or home equity option where you have to refinance it or get a new appraisal in order to increase the amount of equity you have available. With the reverse mortgage line of credit, that's not the case. It automatically increases every year. So absolutely phenomenal options for home equity when it comes to retirement planning. I've also had clients just get equity out of their home approaching retirement. They know that they're going to be retiring in a year or two. They want to shore up their finances, get their emergency funds and other things in play. They'll do a cash out refinance, as we were discussing, pull equity out to put it in these different places to get prepared for retirement. Because what we often find is when it comes to retiring, when you get there, there's a lot of hurdles to overcome when it comes to finances. If you try to get a mortgage or home equity once you're retired, with the exception of a reverse mortgage, it can be very difficult, sometimes impossible, because your level of income has dropped. It's changed significantly. And the way you receive income in retirement may be very different than how you got it, and is likely different from how you received income while you were working. That all factors into the mortgage qualification process and how you get approved. So if you're looking at that for the future, 1 to 2 year out retirement, let's talk about a mortgage strategy around that, whether it be refinance, home equity, or reverse mortgage. The last item that I want to touch on when it comes to uses for home equity, prudent uses, is investment opportunities. Now, this one's a little bit more advanced. This one's for my people out there that may already have debt paid off and are in a good financial position with a bunch of equity sitting there. They want to multiply their equity. They want to build a real estate portfolio or additional investments in net worth. Home equity can be used to fund other investments like buying rental properties, commercial properties, investing in the stock market, or even business capital, starting a business. With careful planning, you can use equity to generate other income. And it's higher risk with higher reward. So I don't recommend investment opportunities, borrowing for that, unless you're an astute, experienced investor. You don't want to be paying on home equity with an investment that went to zero or an investment that went south, okay? So while it is higher risk, if done correctly and with the right tolerance, with the right research, borrowing from home equity for investment opportunities can make sense. I've seen a lot of people use it to expand their business, buy a building for their business, that sort of thing, to create more cash flow, right? So whatever that means. So look at it as a potential option. The main strategy that I want you to see here is interest arbitrage. So what this is about is how much are you paying on your equity interest versus how much are you receiving from your investment interest? So an example with this would be you have a home equity at 8% interest. You're taking that money and you're investing it, and the investment is earning you 10% interest. So that spread between the 8% you're paying and the 10% you're getting, that's the arbitrage spread. That's your profit. You can do this many, many times, but it requires a lot of research and experience. So this isn't something that's low risk. This is definitely a more outside of the box strategy. And I do want to mention it so you know what's possible, because I've had a lot of people, especially high net worth, use their equity for investments in business expansion. Now let's talk through the risks and things to consider when it comes to borrowing equity out of your home. Because as great as the equity is, it's important that you understand the risks and considerations before you go out and tap that equity. So the risk of foreclosure, anytime you take out a loan against your home is the collateral. So if you fail to make payments, you're going to risk losing your home. That's just the way it is. Every state has different foreclosure laws, so check where you're at. But generally, once you're 3-4 months behind, the foreclosure process is going to start. So you need to make sure that the payment is comfortable on the home equity that you're taking or whatever you're doing, because you need to realize that if you fall behind, your home's at risk, period. Market fluctuation. So real estate markets and real estate values are constantly in flux. They're going up, they're going down. If the market value of your home declines, then your home equity can decrease too. And that could impact your ability to sell your home down the line or refinance in the future as well. So an example with this would be maybe you owe $250,000 on your home and it was worth $300,000, but now it's only worth $250,000. So now you owe the same as what it's worth. You don't have any equity in the home. That means that if you try to go sell or refinance, you're going to have to come up with a significant sum at the closing to pay realtor commissions, closing fees, etc. So a lot of people are unable to sell their home at all when they get into this position if the market decreases. Now, as of right now, I'm recording this October 2024, there is little to no risk of a decline, especially in the Northeast U.S. real estate market. We've seen robust values continue to soar. Could we see a slight decline? A few, couple percentage points because of the winter and the seasonality? Yes, but major fluctuation, major 20% decline or something like that? Absolutely not. Okay. So I don't think that that's a risk right now, but as anyone knows that's been in real estate a while, it was a risk for many, many years, and I'm sure it will be in the future. So it's something that you want to be aware of, that real estate market fluctuating. Over borrowing is another big risk. It can be really tempting to borrow as much money as you can, but it's important that you only take the money that you need. It really is, because you don't want to borrow too much. You don't want to stretch your finances too thin. So be careful with that. Again, make sure that the home equity payment fits into your monthly budget comfortably. A lot of time, if you're consolidating debt, you might be saving $500, $1,000 or more a month. You need to make sure to tap into that money and don't let it evaporate into your budget. Make sure that you've got a plan for what to do with all that savings, okay? Now, as we wrap up here, let's talk about some key takeaways. Home equity, as you're seeing, it can really be a huge secret to financial success. It can really be a financial treasure that a lot of people don't even utilize, and many homeowners today are sitting on. So whether you're trying to consolidate debt, make improvements, buy another property and invest, or retirement planning, the equity can help you get there, as we've discussed. So Takeaways. Home equity builds over time as you pay your mortgage down and your home value goes up. You can access your home equity through a home equity loan, home equity line of credit, or cash out refi. And there are many smart ways to use your home equity, but you need to understand the risks and weigh those risks and avoid over borrowing more money than you need. If you're ready to explore how to make home equity work for you, reach out to me and let's have a personalized one-on-one conversation. Let's see what makes the most sense for your situation. Thanks to everyone for listening to our episode today on Connecticut Real Estate Edge. I look forward to helping you with unlocking the financial treasure that is the equity in your home. And be sure to tune in next time for more insights into navigating the world of real estate as well as mortgages. We'll see you then.
Thanks for listening. If you have questions about the information we've covered or would like to discuss mortgage financing for your situation, you can reach Robert Weinberg by visiting www.robgw.com.